You are just 5 steps away to crack the exam. Have a quick cakewalk. Managerial Economics Quick Study Podcast. Step 1 Managerial Economics, Introduction. Introduction. Definition of Managerial Economics. Managerial economics is concerned with the application of economic concepts to the problems of formulating rational decision-making. Man's field. Scope of Managerial Economics. 1. Demand analysis and forecasting for making choice of business. 2. Cost analysis for choosing the factors/inputs of production. 3. Pricing theories to decide price in the market. 4. Profit analysis to find break-even point. 5. Capital budgeting for investment decisions. 6. Market structure for deciding business strategy. 7. Business environment to know the impact of macro environment. Number 1. Demand analysis and forecasting. Demand for a commodity refers to the quantity of the commodity which an individual person is willing to buy at a particular price at a specific time. Demand is made up of desire to buy, willingness to pay for it. This is individual demand. Thus, demand is a function of price. Utility is the basis for demand of a commodity by individual. Product utility satisfies the requirements of a consumer. Consumer's utility is the psychological feeling of pleasure from its consumption to a consumer. It is a post-consumption phenomenon. Indifference curve may be defined as the locus of points each representing a different combination of 2 substitute goods, which yield the same utility to the consumer. When such combinations are plotted on a graph, it results in indifference curve. It can also be called as ISO utility curve. Decline in price causes the real income of the consumer to increase, which induces more buying capacity. This is called income effect. When price falls, but prices of other related goods remains constant, commodity becomes relatively cheaper. This makes the consumer to replace costly goods with these cheaper goods. This is called substitution effect. Demand function sets the relation between the demand and the factors that influence the demand. Demand for a commodity not only depends on the price of a commodity, but also on the income, price of substitutes and complementary goods, tastes, habits of consumer. Law of demand tells us the effect of changes in price on the demand in terms of increase or decrease, but does not inform about the degree of responsiveness of consumers to a price change. Elasticity of demand is the measure of the responsiveness of demand to changing prices. The measure is known as the elasticity coefficient, ED. Demand forecasting is an estimate of demand during a specified future period based on a proposed marketing plan and particular uncontrollable and competitive forces. Condiff and still production function is the technological relationship between all the inputs and outputs, which can be represented in the form of an equation. The production function may take the form of a schedule, a table, a graph, or curve, or a mathematical equation. Q equals F, L, K, M, T, T, LB, where Q equals quantity of output, T equals technology, L equals labor, M equals material, LB equals land and building, T equals time, K equals capital. ISO quant curve can be defined as the locus of all those points representing various combinations of 2 inputs, capital and labor, yielding the same level of output. It is also called as equal product curve or production indifference curve. When both these inputs can be changed in long run, relationship between inputs and outputs can be explained by laws of returns to scale. Law of returns to scale explains the behavior of output in response to proportional and simultaneous change in all the inputs. This can be possible in long run when production capacity can be increased beyond its maximum limit by increasing fixed as well as variable factors of production. This is an expansion of scale of production. Advertising is any paid form of non-personal communication by an identified sponsor. Aim is sales promotion of goods and services to the mass customer. Number 2 Cost analyses. Fixed cost, FC, are costs incurred on production firm which is fixed in short run irrespective of the volume of output level. These are incurred even if production comes to halt. These include office overheads, depreciation on machinery, building, maintenance of firm, etc. Fixed costs are also known as general costs, supplementary costs, and indirect costs. Variable cost, VC, also known as prime costs or direct cost, it varies with the variation in the volume of total output. It includes cost of raw material, running cost of fixed capital, direct labor charges and costs of all other inputs that vary with output. Total cost, TC, it is the sum of fixed costs and variable cost. TC equals FC plus VC. Total cost curve TC moves parallel to total variable cost curve, TVC, because difference between TC and TVC is FC, which remains constant. Average variable cost, AVC. AVC declines at initial stage due to law of increasing returns. It becomes constant when firm attains its full capacity. AVC starts to increase due to application of law of diminishing returns. Thus, AVC gets U-shape in long run. Same is applicable to average cost curve. It is also U-shaped. Marginal cost is the change in the total cost that arises when the quantity produced is incremented by 1 unit. It is the cost of producing 1 more unit of a good. Incremental cost refers to total additional cost associated with the decision to expand output or to add a new variety of product or to replace worn-out plant and machinery. It is also termed as differential cost. Number 3. Pricing theories. Price discrimination refers to the practice of a seller of selling the same goods at different prices to different markets. This variation in prices does not reflect variation in costs in two markets. It is practiced in order to maximize profit. In a complex business world, the business firms have to consider various factors while deciding the price for a product. There can be several strategies that can be adopted by a firm for deciding price, like 1. Cost plus / markup / average cost / full cost pricing. 2. Multiple product pricing. 3. Transfer pricing. 4. Pricing in life cycle of a product. Skimming pricing, penetration pricing, Veblen effect. Product life cycle stages, introduction, growth, maturity, saturation, decline. Number 4. Profit analyses. Break-even analysis helps the firm in determining this break-even point at which firm is at PARIE, revenues are equal to costs and no loss no profit situation has arrived. Break-even analysis, also known as cost volume profit analysis, is a technique to study the relationship between the total costs, total revenue, and total profits or losses over various levels of output. Contribution equals FC plus P or SPVC. Number 5. Capital budgeting. Capital budgeting refers to the process of planning capital projects, raising funds, and efficiently allocating resources to those capital projects which are expected to generate returns for more than 1 year. These include setting up new plants, installing machines, purchase of heavy vehicles and trucks, purchase of IT products for office automation, expenditure on R&D work for product innovation. Expenditure on advertisement for long period can also be the part of capital expenditure. Payback period is also called as payout method, calculates the total time period, in number of years, required to return the original investment. From this, the firm can find out the time period in which it can recover its invested funds. It does not take into account depreciation on the machines. Net present value is based on the concept of time value of money. Money expected to be received 1 year later is less valuable than the same amount received today. This is due to the fact that we can earn interest on the money in hand in that time period. Internal rate of return is also called discounted rate of return or time-adjusted rate of return method. This is the rate of return which equates the total outlay on project with the total net present value of annual cash inflows. Also called as marginal efficiency of investment and break-even rate. Average rate of return is the ratio of net average annual income from the project to the initial investment. It does not consider time factor. Profitability index is the ratio of net present value of cash inflows to the present value of cash inflows and the present value of cash outflows. This index considers the time frame or discounted rate of return. Number 6. Market structure. Market structure is determination of the type of market and degree of competition in the market, depending on the number of sellers, is divided into perfect and imperfect competitions. Perfect/pure competition describes a market in which there is complete absence of direct competition among economic groups. It is characterized by the presence of large number of firms selling homogeneous products with no product difference, like farm production and financial market products. Monopoly means an absolute power of a firm to produce and sell a product that has no close substitute in the market. The cross-elasticity of demand for a monopoly product is either zero or negative. Firm and industry are identical in a monopoly competition. Monopsony is also termed as buyer's monopoly. Monopsony refers to a market situation when there is a single buyer of a commodity or service. The monopsonist can influence the supply price of his purchases by the amount he buys. The monopsonist regulates his purchases in such a way that MC equals mu, whereby his consumer's surplus is the maximum. Monopolistic competition is a market setting in which many firms sell differentiated products. Differentiation is made by way of different brand names, trademarks, designs, colors, shapes, packaging, qualities, etc. But, still each product is a close substitute for the rival products. Each firm enjoys a quasi-monopoly over its product. Examples are movie theaters, FMCG products, dresses, restaurants, consumer durables. This is perceived difference in the minds of customers. Oligopoly is characterized by few firms or sellers selling homogeneous or little differentiated products. The number of sellers is so small that the market share of each firm is large enough for a single firm to influence the market price. Examples are mineral water, cigarettes, aluminum, steel, cement industry. The analysis of kink demand curve brings out fact about oligopoly market. Oligopsony, from ancient Greek few plus purchase, is a market form in which the number of buyers is small while the number of sellers in theory could be large. Bilateral monopoly refers to a market situation in which a single producer or seller, monopolist, faces a single buyer, monopsonist. Equilibrium price can be determined by non-economic factors such as bargaining power, negotiation skills, etc. Number 7. Business environment. Business environment refers to the summation of all the factors which are controllable, internal, as well as uncontrollable, external, by the organization. These factors influence the business activity on large scale. Example: value systems of society, government rules and regulations, monetary and fiscal policies of government, employees in the organization, customers, suppliers, etc. Internal environment refers to all the factors within an organization which are directly responsible for the growth or fall of the business unit. External environment includes all those factors which are outside the organization, which cannot be controlled. These are micro and macro. National income as product flow is the total monetary value of all final goods and services produced which have market value in a country during a period of 1 year. National income as money flow is calculated by adding all money flows due to production activity. This is done by adding all factor costs like wages, rents, interests, profits and earnings of self-employed. National income equals wage income plus capital income plus other income. Gross domestic product (GDP) is the money value of all goods and services produced within the domestic territory of a country during one financial year, including consumer goods/capital goods, in private sector/government sector. GDP equals consumption plus government spending plus investment plus net exports. Net domestic product equals GDP depreciation on fixed capital. Gross national product, GNP, equals GDP plus net factor income from abroad. Net national product, NNP, equals GNP depreciation on capital. NNP at factor cost equals NNP at market price. Indirect taxes plus subsidies equals GNP at market price. Depreciation, indirect taxes plus subsidies equals national income. Private income equals NNP at factor cost, plus transfer payments, deductions, disposable income equals personal income direct taxes. Step 2 Basic concepts of managerial economics from previous questions. 1. Law of demand establishes qualitative or directional relationship between demand and price. 2. Demand curve for a commodity is drawn on the assumption that the taste, income, and price of other goods remain constant. This assumption is termed as ceteris paribus. 3. Perfectly elastic demand at equals yen, infinite. 4. Perfectly inelastic demand at equals 0, 0. 5. Unitary elastic demand at equals 1. 6. Relatively inelastic demand at and LT1. 7. Elastic demand, at and GT1. 8. Exception to the law of demand demonstration effect goods, Giffin's inferior goods, future scarcity of goods, ignorance of consumer. 9. Demand curve moves downward due to law of diminishing mu and income effect. 10. Elasticity of demand measures the responsiveness of demand to change in prices. 11. Income elasticity EI equals where Y equals income Q equals quantity demanded. 12. Arc elasticity EA equals. 13. Movement along demand curve due to change in price causes expansion or contraction of demand. 14. Shift in demand curve due to change in factors other than the price like income, taste, price of substitutes or complementary goods causes increase or decrease of demand. 15. Production possibility curve is concave to origin because of increasing MRT, marginal rate of transformation, between X and Y. 16. In case of Giffin's goods, price effect is negative with increase in price, demand decreases. 17. If demand curve is a rectangular hyperbola, elasticity is 1. 18. Cross elasticity of demand for substitutes is positive. 19. Cross elasticity of demand for complementary goods is negative. 20. When average revenue becomes constant, AR equals MR. 21. The falling part of total utility curve shows negative marginal utility. 22. Total utility is maximum when mu equals 0. 23. At the shutdown point, a firm is having all total losses equal total fixed cost, total revenue equal total variable cost, price is equal to average variable cost. 24. The emphasis of managerial economics is on normative theory, which is more of empirical study. 25. Cobb-Douglas production function is linear homogeneous production function of first degree presented as P equals K1/4L3/4C1/4. 26. Condition of perfect competition, firm's equilibrium is MC equals MR, where MR equals price, the slope of MC should be greater than slope of MR. Long run equilibrium of the firm is established at minimum point of LAC. 27. Long run average cost curve, LAC, takes L shape because of two reasons: technological progress and learning by doing. 28. Under price discrimination, market having less elasticity of demand can be charged higher price. 29. Economics of scale implies reduction, in unit cost of production. 30. Law of equimarginal utility equals MUM. 31. In case of unitary price elasticity of demand, total expenditure remains constant, i.e., has no price effect. 32. Diamond water paradox establishes the fact that marginal utility can be low but total utility will be high for necessary goods like water. 33. GNP equals GDP plus net faction income from abroad. 34. NNP equals GNP depreciation. 35. Monopoly equals single seller. 36. Bilateral monopoly single seller, single buyer. 37. Monopsony equals single buyer, many sellers. 38. Duopoly equals two sellers, many buyers. 39. Learner's degree of monopoly power equals. 40. SAC is U-shaped and more pronounced. 41. LAC is U-shaped and less pronounced envelope of SACs. 42. Stages of PLC, introduction, growth, maturity, saturation, decline. 43. BEP, units, equals. Step 3. Great economists. 1. Father of economics Adam Smith. 2 Micro and Macroeconomics Ragnar Frisch. 3 Marginal Utility Analysis Alfred Marshall. 4 Law of Diminishing Marginal Utility Heinrich Gaussen. 5 Demand Paradox for Inferior Goods Sir Robert Giffen. 6 Consumers Surplus Marshall. 7 Value and Capital Book J.R. Hicks. 8 Theory of Circular Causation Ragnar Nurks. 9 Indifference Curve Analysis Hicks and Allen. 10 Revealed Preference Theory Samuelson. 11 Substitution Effect Hicks Allen. 12 Scientific Touch to Indifference Curve Analyses Phi Edgeworth. 13 Principles of Economics Alfred Marshall. 14 Diamond Water Paradox Adam Smith. 15 Asian Drama Gunnar Myrdal. 16 Language of Economics J.K. Galbraith. 17 Degrees of Price Discrimination A.C. Pigou. 18 Kink Demand Curve Hypothesis Paul M. Sweezy. 19 Demonstration Effect Thorstein Veblen. 20 Product Exhaustion Theorem Clark Wicksteed. 21 Demand Schedule at Various Prices Catherine. 22 Monopsony Concept Mrs. J. Robinson. 23 Infant Industry Argument Friedrich List. 24 Social Accounting Concept J.R. Hicks. 25 Zero-Based Budgeting Jimmy Carter. Step 4 Managerial Economics. Quick recap from previous questions. Practicing previous year solved papers can help you in many ways in your exam preparation. 1 Demand curve under monopolistic competition is downward sloping and flat. 2 If two commodities are complementary, then a rise in price of one commodity will induce a backward shift in demand for the other commodity. 3 If the demand curve is rectangular hyperbola, resembling X, the elasticity is unity. 4 Income is a flow variable whereas product, capital formation, and wealth is a static variable. 5 Supply creates its own demand is known as Say's law. 6 In the law of variable proportions, phase 2 indicates diminishing returns. 7 The demand curve facing the pure monopolist is negatively sloped. 8 Total consumer expenditure on a good falls as its price falls, this indicates that its price elasticity is less than 1. 9 National income is NNP at factor cost. 10 A firm produces output using labor and capital. If prices of both inputs double, then the total minimum cost of producing any given level of output is doubled, provided the firm has constant returns to scale technology. 11 In the long run a firm under perfectly competitive market earns only normal profit. 12 National income at current prices is equal to NNP at factor cost. 13 A monopolist always charges a price which is greater than marginal cost. 14 The kinky demand curve hypothesis predicts sticky prices in the market. 15 Price elasticity of demand for luxury goods will be infinitely elastic. 16 In the short run, profit maximizing firm produces additional units of production, as long as marginal revenue exceeds marginal cost. 17 In the typical demand schedule, quantity demanded varies inversely with price. 18 Shutdown point is that point where price is equal to variable cost. 19 Bank rate, CRR, and trading of shares in open market are monetary policies but taxation is a fiscal policy. 20 The assumption that economic conflict between the organizations leads to innovativeness and the new product development, technological advancement, and better services at lower prices, refers to cost reduction strategy. 21 ISO cost line is also called as production line. 22 Quadratic cost function is written as TC equals A plus BQ plus CQ 223. Transfer pricing is referred to as price charged under intra-firm transfer of product. 24 Margin of safety is above the break-even point. 25 Profit is maximized when marginal cost equals marginal revenue. 26 The shape of short-run average cost curve is U-shaped. 27 Bax-Jenkin is one of the important methods used in trend projection of sales forecast. 28 The Cobb-Douglas production function has the equation P equals AK, A, L, 1A. 29 Skimming price for a new product is high initial price. 30 Under monopoly market structure, the degree of freedom in pricing decision is quite good. 31 Capital budgeting decisions are generally irreversible. 32 Intervention of the government is not the prerequisite of a perfect market. 33 The demand curve of a monopolistically competitive firm is highly though not perfectly elastic. 34 A decision maker has to remember the proverb, a bird in hand is worth two in bush, while he examines opportunity cost principle. 35 Market with one buyer and one seller is called bilateral monopoly. 36 Cardinal measure of utility is required in utility theory. 37 In case of Giffen goods, price effect is positive. 38 The term opportunity cost refers to cost of one product in terms of production of others sacrificed. 39 Consumers' willingness to pay, actual payment is called consumer's surplus. 40 The payback period refers to the number of years a project takes to recover its investment cost. 41 In the case of Veblen goods, demand curve will slope upwards. 42 Monopolist can decide either price or quantity but not both. 44 Price elasticity of demand is best described as the rate of response of demand to a change in price. 45 Giffen goods are those goods for which demand increases as price increases. 46 The situation where market consists of only two buyers is known as duopsonate. 47 Short-run cost curves are influenced by laws of variable proportion. 48 The term opportunity cost refers to cost of one product in terms of production of others foregone. 49 The elasticity of demand indicates the rate of response of demand to a change in price. 50 A rightward shift in supply curve indicates an increase in supply. 51 The condition of equilibrium for the monopolist is MR equals MC 52. Price control leads to rationing and black marketing under perfect competition. 53 If both supply and demand increase by the same proportion, price remains constant. 54 During last 5 years, per capita income of India is increasing, that means national income growth of India is more than the population growth. 55 In the short run, firm considers the minimum of its average variable cost curve as shutdown point. 56 The positive cross elasticity of demand between two products means two products are substitutes. 57 A monopolist always operates in the elastic segment of its demand curve. 58 The price elasticity of demand for any product in the long run is more than its short run value. 59 Under perfect competition in the long run, all firms earn normal profits. 60 National income at market prices is equal to net national product at factor cost. 61 If there is a single buyer, it is called monopsonate. 62 Time value of money is considered for net present value, internal rate of return but not for payback method. 63 A firm is having increasing returns to scale means it is having decreasing costs. Step 5 Demo exam from latest net paper. It's time to practice 5 questions related to managerial economics from previous year solved paper. It can surely help you in many ways in your exam preparation. Let's start. 1 From the following determinants of the price elasticity of demand, indicate the correct code for the determinants having a positive relationship with the degree of the price elasticity of demand. A. Range of substitutes of the commodity. B. Extent of the different uses of the commodity. C. Portion of the income of the buyer spent on the commodity. D. Income group of buyers purchasing the commodity. Code 1. A. And B. Only. 2. C. And D. Only. 3. A. B. And C. Only. 4. B. C. And D. Only. To match the items given in list, I with those given in the list, 2 and suggest the correct code. List, I. List 2. A. Marginal/average productivity. B. Substitutability of inputs. C. Constant negative slope. D. Convex to origin. I. ISO quant curve. 2. ISO cost line. 3. Production function. 4. Elasticity of production. Code A. B. C. D. 1. I. 2, 3, 4, 2, 2, I, 4, 3, 3, 4, 3, 2, I, 4, 3, 4, I, 2. 3 from the following two statements of assertion, A, and reasoning, R, suggest the correct code. Assertion, A. The equilibrium price is decided at the level where the quantity demanded equals the quantity supplied. Reasoning, R. At this level excess of demand and excess of supply both remain zero. Code, 1, A, is correct but, R, is incorrect. 2, A, is incorrect but, R, is correct. 3, A, and, R, both are correct but, R, is not right. Explanation of, A. 4, A, and, R, both are correct and, R, is right. Explanation of, A. 4. Despite differences in cost of production, the oligopolists will not vary the prices of their products as per which combination of the following models: A. Collusion model, B. Cournot's model, C. Kink demand model, D. Price leadership model. Select the correct code. 1, A, and, B, only, 2, C, and, D, only, 3, A, and, D, only, 4, A, B, and, C, only. 5. For the following two statements of assertion, A, and reasoning, R, suggest the correct code. Assertion, a low initial price regarded as the principal means for entering into mass market for some new products. Reasoning, R. Firms generally enter into production of new products with excess capacity of the plant initially. Code, 1, A, is correct but, R, is not correct. 2, A, is not correct but, R, is correct. 3, A, and, R, both are correct and, R, is right. Explanation of, A. 4, A, and, R, both are correct but, R, is not right. Explanation of, A. Now, it's time to know the correct answer keys. Let's check. Questions. Answer keys: 1 to 3, 3, 4 to 5, 1. Thanks for watching Fuxail Pro. Congratulations in advance.